Welcome to EWA's FIN-LYT podcast. EWA is a fee-only RIA based out of Pittsburgh, Pennsylvania. We hope all listeners of this podcast will benefit as we deep dive into complex financial topics that we will make simplified for you. And we hope that this really serves as a catalyst so that you can make the best financial planning decisions for your family and also save time. Today, I'm joined by Ben and Devin. We're talking about the new tax bill that was just pretty controversial, but just passed and now going to be live. So every time we have Ben on the podcast, though, he's our master sports picker. So we got to ask. We're recording this. What day is today?
Wednesday, right before the British Open.
Yeah, right before the British Open. So got to get your guys' picks.
I love this. This is going to come out in like 3 months, and so
wait, the last time when you picked it right, I would just watch the one you picked Ohio State. It was like a year later we published it. No, I'm just kidding. That was pretty soon after.
I think you had Scotty for the U.S. Open though.
Yeah, I'll say Rory. I mean, we're back at Royal Portrush. This is in Northern Ireland where he's from. If you remember, this was the tournament. They hosted the British Open back in 2019. Rory made a quad bogey 8 on his first hole, missed the cut.
Ooh.
Can't do any worse than that. So I think it's behind him. I think he's going to play really well this week.
Okay. Devin, how about you?
I'm going to go with Scotty. I think he's got it. I think he's in the right frame of mind and he's locked in.
I've been locked into a lot of stuff we have going on here, so I'm not even sure of the live. Like, is Bryson playing in this one?
Bryson will be playing, yeah.
All right, I got to go with Bryson.
He's not exactly a links master, Bryson. So this is not really the.
All right. Well, let's give a quick background. So, who wants to give a background of before we get started? So, just so you know, this is a huge bill. How many pages is it? Do you guys know?
It was like 800 or something.
Okay, so there's a lot of stuff in there, a lot of stuff that affects corporations. We're honing this down on the top 10 of what we think will actually affect our clients. And our clients are physicians, retirees, executives, corporate leaders, people generally in like the top quartile of incomes and net worth. So we narrowed down just the top 10. This isn't going to be more than a 20 to 30 minute podcast. So we just wanted to, instead of having this really boring podcast, we figured we could give you like here's what you need to know that will immediately affect you. So let's start with a quick background and then we'll get right into the top 10.
Yeah. So in 2017, during Trump's first administration, they passed the first Trump Tax Cuts and Jobs Act of 2017. This piece of legislation is essentially an extension of a lot of those actions. That is the biggest thing to know. Matt, you mentioned earlier that it's a big, beautiful bill. There is a lot in this bill. So again, we're gonna probably cover 10% of the bill. There is a lot going on. And not to kind of bury the lead, but the biggest takeaway, and you guys can disagree with me if you think so, but the biggest takeaway is that it's really just an extension of the current tax situation. So a lot of high income earners and high net worth folks were staring down the barrel of like a major tax change if a lot of this stuff wasn't extended.
Yeah.
So that's the biggest thing to know here is that it's mostly status quo. Most people won't have an impact. It won't affect most people in a significant way, but it extends a lot of good, let's call them tax breaks for the foreseeable future.
Specifically on the ordinary income side, the top tax bracket is staying at 37%. If this did not get passed, the tax rates were scheduled to sunset back to where they were prior to 2017. So the highest rate would have been 39.6. So
and some of the other rates would have been squeezed, right? So I read a statistic like 60%. If this hadn't been passed, like 60% of taxpayers would have gotten a tax increase come January 1st, 2026.
That's right.
So
Exactly.
it's not just like, and just doing the math, like the highest tax bracket, I think starts from married filing joint like at 750. So now instead of if someone's making $1 million, that extra between 750 and $1 million, instead of that extra 250 between 750 and $1 million being taxed at 39.6, that's going to stay at 37. So back of the napkin math, whatever that is, like $6,000 or $7,000 of tax savings for that $1 million just in federal income taxes.
Yep.
And there's other factors of that. Well, just put to highly, there's the tax rates that you are used to will be inflation adjusted, but they're going to stay. It's not going to go back to where they were prior to 2017.
That's right.
So, okay, that's number one. So number two is around estate planning. I'll cover that one. So this was a big one because we had a lot of conversations. There was the highest estate planning exemption. So everyone has a lifetime credit, and that's $13.99 million, which is around that up to $14 million. That's going to inflation adjusted at $15 million next year, and then 20 for a single, and then $27.98 million to $30 million. So just double that if you're married filing jointly in 2026. So now if you have a really high net worth and you die with $30 million or less, there's no 40% tax. If you die, let's say with $40 million, you're married filing jointly, $30 million in the past, your kid's tax free. Without any planning in place, the extra $10 million would get taxed at 40%. You'd have a $4 million tax bill at a federal level. You'd also maybe have some state inheritance tax considerations depending on what state you live in. But this is the highest level we've ever seen in recent years. This was as low as $1 million per person a couple of presidencies ago. So this is set in stone, but obviously politics could change that in the future.
Mm-hmm.
But this is an opportunity in the next really 4.5 years to do it, to get your estate planning and avoid taxes.
For sure. And would you say, Matt, this higher exemption limits is more opportunities to get more money out of your estate and utilize a larger credit amount now that you have it?
If you're high net worth and have the flexibility to start, shifting assets away from your plate and onto kind of the family plate where you don't have the control of them anymore, absolutely. If have just accumulated enough for you to be secure, I would be looking at setting up revocable trust and things that are flexible. I wouldn't be, making any all-in decisions yet. Okay. And we've done many topics, estate planning podcast videos, short form videos that talk about revocable versus irrevocable in estate planning and how to avoid taxes when you pass your money to your kids, either while you're living or when you die. Let's go to number 3, which is around the SALT. So, Devin, do you want to handle that one?
Yeah. This one probably got the most media coverage over the last few months, but SALT is the state and local tax deduction. I believe in the last currently it's $10,000. That's the cap. That's been increased to $40,000. So that's big for folks in high income tax states.
So example of that, Pennsylvania is no joke. It's 3%.
Yeah.
And if you live downtown, it's another 3%. Local taxes, right?
Yep. And 6%. if you itemize, those taxes can be they can be deducted.
But this really, I think, affects like cities with
New York, California,
exactly,
et cetera. So. Opposite end of the spectrum, if you're in Texas and Florida, et cetera, not much of an impact, right?
Zero, yeah.
So again, the exemption amount was increased from 10 to 40,000, so that's big. However, there's a big fat phase out at 500K of income. So for married filing jointly couples, if you make more than 500K to 600K is when it phases out completely. But again, there is that maximum on income. If you make that amount of money, that $40,000 kind of trends downward to eventually zero if you make 600K. So,
which isn't that interesting though? Because like in New York City, you kind of need to make that kind of money to live there, but there's no benefit. So it's like trying to make it more attractive for some of those cities to live there as high income, but then they took that away for the high income people. So it's like, okay,
well, it's part of the
you're making
kind of the
$250 and you want to live like in a 2-bedroom in New York City. Good luck.
Yeah. So it's almost I don't know if this is accurate, but it's almost 2 steps forward, 2 or 3 steps back for those folks, where it can actually be a net negative if you make, let's call it 575 as a couple. It can actually hurt you by taking that deduction. So contact your tax professional if you have any questions on that, but this is probably the section of the bill that got the most media coverage because it was negotiated so much between the House and the Senate. It went to 10, it went up to 50, and then back to 40, and we don't want this is beyond the scope of this podcast, but just know that the SALT cap has increased to 40K. So
yeah,
absolutely.
And if you're not itemizing your deductions, you're taking what's called the standard deduction.
Brings us right to number 4.
That was kind of flawless. I don't know.
This was an easy one. I thought maybe I could have taken it, but no, go ahead. Feel free.
The standard deduction has been $30,000 for 2025. With the changing in this bill, if you're married filing jointly, it's now $31,500. So it's an extra $1,500 if you're in the 37% bracket. That's an extra couple $100 to be saving from that. They've also increased for single filers and those head of household as well. These are indexed for inflation, so they're going to be going up every year. From a senior citizen standpoint, each taxpayer 65 or older is able to get up to an additional $6,000 deduction. There's a phase out by 6% of your modified adjusted gross income above $150 if you're married filing jointly and above $75,000 otherwise. That's on top of the regular standard deduction and the additional standard deduction for seniors, which you have. There's if you're over 65, you can already kind of get that additional standard deduction. So pretty simple, but that is a welcome change for a lot of people because I would say most people are using the standard deduction, so people will feel that impact.
Mm-hmm.
Yeah, the only people that are not using standard, business owners or people that are doing extreme charitable contributions. I mean, it's tough. Most of the population is now using the standard deduction, so it's simplified, I think, some of the tax returns from that perspective. Okay, Devin, what's next?
Yeah, so number 5 is so as Ben alluded to, you can either choose to itemize your deductions or take the standard deduction. Another change is if you are making charitable contributions and you take the standard deduction, you can deduct an additional $2,000 of philanthropic or charitable contributions. So that is big for a lot of our clients. It's an extra $2,000 to your deduction for that.
Absolutely. And then let's hit number 6 too, Devin, to the itemized deduction haircut.
Yeah. So so right now there is for example, for medical expenses, in order to itemize medical cost, they have to be above, I think it's 7.5% of your AGI right now. So similar to that, to take deductions on charitable contributions, they have to be above 0.5% of your AGI. So for example, let's say you make $100K as a couple and you donate $2,000, that first $500 would not be deductible. So anything above 0.5% of your AGI is deductible. That's a big change.
Yeah. Absolutely. Okay. Number 7 is the Trump account, which is really weird to me. Like, I thought, why would these be named Trump accounts? I thought he was like a humble, you know what I mean? Like a humble leader guy. So.
Well, get into these because there's pros and cons to
the Trump account. I think they should be named the Elon account. No, I'm just kidding. All right. So anyways, new savings account for children born in 2025 through 228. All children are U.S. citizens. Each child gets $1,000 from the federal government at birth, and it's going to track a major U.S. stock index. Do you think we can convince Trump that like EWA can manage these? Probably not. Parents would then be able to contribute up to $5,000 a year, and the balance will be invested in a diversified fund that tracks the U.S. stock index. First contribution will be allowed 1 year after enactment of the law. Contributions only allowed until 18 years old. No deduction allowed for the contributions account. Employers could contribute $2,500 to the employee's account. It wouldn't be counted as income to the recipient. Okay. Earnings, growth, tax deferred, and qualified withdrawals are generally taxed as ordinary income. Is that just on the basis? Or I mean, just on the growth?
Correct. Yeah.
So that's kind of like an annuity.
Yeah.
Basis comes out tax-free. Earnings are. Yeah, this is kind of dumb in my opinion.
Yeah, I we're trying to keep it between the mayo and the mustard, keep it factual here, but there's.
Sometimes I like to give my opinion.
See a lot of.
What's that? Sometimes I like to give my opinion. You have strong opinions about Rory McIlroy winning. I just have opinion on this.
Yeah, I just think if you got a few bucks left over for your kid, it's going to a 529 before it's going to a Trump account. But that's neither here nor there.
Can you name your 529 a Trump account though?
I don't think so.
There's some branding differences maybe there, but no. The real question is this better than a direct index account? Because like the reality is, you put $100,000 in here of basis, and it grows to 5,000 times 18, probably be indexed for inflation. So okay, 91,000, 1,000 up front, and then the 90,000 you put in, that grows to $1 million. Let's say the kid's 65. 91,000 is tax free. The other 909,000 is growth at taxed at income rates.
Right. Why
wouldn't we put that 91,000 in a stock account, and that 909 is taxed at capital gain rates, which are probably going to be half the rate of income rates? Absolute stupid.
Yeah.
Free money is free money.
Right. This is almost like a bond.
Yeah.
You're getting it. Yeah.
Why would you put your own money into this?
No,
it's dumb.
I'm with you. Yeah.
All right. Number 8, QSBS. Ben, Devin, who wants to handle this?
So I got it. So QSBS is qualified small business stock. It allows C Corp owners to deduct gains on stock in their company. So this is great for small business owners, startup founders, etc. So currently, you have stock in a business, you sell it up to, I believe it's $10 million of gains can be tax deductible, assuming that you had stock in the business for at least 5 years. these are changing. So that $10 million is increased to 15. So those are $15 million in gains. It can be completely tax deductible. But instead of kind of like it's a cliff at 5 years, there are kind of tiers in the holding period. So at 3 years, you can deduct or exclude 50% of the gains. At 4 years, you can deduct 75%, and at 5 years, again, it's the same kind of 100%. So it's kind of graded instead of having that cliff. Some other kind of nuances. Again, the first S is small business. So the limit used to be $50 million in assets. That's been bumped up a bit to 75. So it's kind of small to medium sized C corps. And again, it has to be a C corp. So
there's certain industries I know, like our industry is excluded. There's certain industries are excluded.
Yes.
This is like tech, stuff like that.
Yeah, I believe physicians are also excluded. Is that right?
I researched for a client HVAC company would qualify.
Okay.
The certain kind of services. But yeah, I believe physicians, financial advisors, some other professional services are excluded from this.
Yeah.
So yeah.
So in sum, again, kind of from the beginning is that it's an extension of the current tax code essentially with additional benefits. So if you're kind of just, if you're deciding whether or not to file as S corp versus C corp, whether or not to start a company, this is highly relevant to you.
Absolutely. Okay, let's talk about the expansion of Section 179. So, Ben, you want to handle this one?
Yeah, so this is a 179 is a deduction that allows businesses to deduct the full purchase price of any qualifying equipment or software that you purchased or financed during the tax year. And this is specifically in regards to the bonus amount. So you're now able to deduct that full purchase price in 1 year instead of depreciating the cost over multiple years. That bonus amount over the past few years has gone down. Previously, it was 100% that you can deduct. It's gone down to 80, 60, so on and so forth. This now just reverts it back to 100%, which it was a few years ago. So you can deduct that full bonus depreciation in the amount of 100%.
And that's now $2.5 million up from $1 million.
Correct. So the limits have increased. So the phase out begins at about $4 million of property. That's up from $2.5 million. And like you said, Matt, it's now $2.5 million eligible. That's up from $1 million. So that's a pretty big adjustment.
It's qualifying equipment. We talk about Section 179 a lot with the 6,000 pound vehicle. That's staying down. I think it's just like it's a limited amount. I believe it's like $30,000 or something you can do, and you can deduct the rest of it over the next 5 years or whatever. But this is qualifying equipment. There's still some cars, like I think it's 14,000 pound trucks or whatever.
Yeah.
And other bigger equipment, like if you're hauling like on a semi truck or something, that would be fully deductible. Yep. But this is like for big, more medium sized, big, not like a single run. So like you know what I mean, a single person business that's going to go buy like a
asset heavy businesses as well, typically not professional services.
Yeah, exactly. Okay, and then last one, the 21% corporate tax rate is now permanent. So this does make C corps more attractive because even though the double taxation, you have that plus the QSBS, and then at the highest tax bracket, C corps, they're getting closer to the S corp tax rate. They're still, if you're not going to ever sell your business, you'd be better off staying in an S corp, even at the highest tax bracket. But if you're like, I'm going to sell, I'm going to do a QSBS, there is going to be some massive savings, assuming you qualify for that QSBS if you convert to a C corp. But that's an individual analysis you have to do as well.
Yeah, we're talking millions of dollars in potential tax savings here. So it's big and it's big and it's nuanced. So if you have any questions,
yeah, and you can do the thing about the QSBS is that's per individual. So like if you had like a $40 million business, like or $60 million, you could do like put some shares in your name, put some shares in your wife's name, put some shares in a trust for your wife, some shares in a trust for your kid. Like you could get all of it excluded inside of your family if you're married and kids. So there's strategies around to get it all tax free, which could be 10, 15, $20 million of taxes saved. Yeah. Maybe you give up $1 million of income tax along the way, but you're saving 20 or 30 in the back end and taxes on the exit. So definitely a strategy to be heavily considered. So that's it on the number 10. So I know you guys wrote this, Devin, not to throw you wrote this outline. The Trump was one of the 10 that we chose. The Trump, that $1,000 account. I just have to question if that one should have been in there or not. So is there anything, if we were to go back and record this over, which we're not, what would you have chose to replace the Trump account with?
Look, that was
or
number,
should that be in there?
That was number 7 for a reason. It was scraping the bottom of the barrel at that point.
Keep in mind, we really took a focus point on just the financial aspects of this bill. Sure. There's a lot of healthcare aspects, student loan aspects that we're going to be getting into and other resources. We just really wanted to focus on some of the highlights on the financial side.
So is there any like runner up that maybe could have been the top 10 that you guys can think of, or?
child tax care credit, but I don't think that's worthwhile.
Well, you can't say it without giving a little background to it. So what changed with the child tax care credit?
So if you have kids, you get a $2,000 deduction, credit on your taxes. That is increased to $2,200. So if you got 5 kids, that's another $1,000 in your pocket.
Yeah, still phased out at $400,000 for married filing jointly, but if you're under that, absolutely.
Exactly.
And some of this tax code is just crazy because how are you going to afford like 4 or 5 kids with the low? And it's like
it's like a lot of it is it's performance.
Politicized.
It's performance.
Yeah, it's
like I mean,
politicized.
there's one of the big talking points is like no tax on tips. Like that is a part of this, but it's only up to a certain amount. It's only a certain above the line deduction. Like if you read the fine print, it's not as simple as no tax.
What about Social Security?
Yeah, that's
a big one.
Like what Ben was saying. So during Trump's campaign, he talked about what? No tax on tips, no tax on overtime, and then no tax on Social Security.
Yeah.
Right. That's kind of why this bill exists, and they're in the bill, but they're not as
it's not going to affect
cut.
someone with high income.
Exactly.
Gotcha.
So
thereby, it's not going to affect our clients materially.
it will. I think, in my opinion, again, there's a lot still coming out, but if you're ultra high net worth, it will have an impact. If you're on the lower end of the spectrum, it will have an impact. For the middle 80%, it will have some impact. So not as drastic as you would think. And again, it's more of an extension of what's currently in place. So it's it's like
should we start accepting tips? Like if we do a really good job and clients want to tip us,
we could, yeah.
Let's get some tax-free income.
Flip the thing around and 22%.
How would those get divvied up amongst the?
Should we split them?
That'd be a hilarious discussion.
Ben wants
We're
to
not
get-
asking for tips, but maybe we should.
Yeah, we
Tax-free
could.
now.
Yeah.
All right. Well, thanks for joining us, everybody. We will have a follow-up podcast on the student loan because I know there was some significant change on the student loan, and we'll address the retired ones with the Social Security as well.
Yeah, we also have a blog coming out, so a written resource to help kind of reference some of this as well.
Thanks for tuning in to our podcast. Hopefully you found this helpful. Really hope this is as beneficial and impactful to as many people across the nation as possible. So hit the follow button. Make sure to rate the podcast, and please share with any friends or family members that would also find this beneficial. Thank you very much.